Let's wait and watch for that one. Let's get in our fundamental voice on the show as well. Chakri Lokapriya, Managing Director at TCG Asset Management, joins in. Chakri, what a day to have you. Good morning. Almost everybody that we've spoken to since the morning, Chakri, are saying that this is a positive surprise. It was anticipated, maybe not so quickly. The question now that we have is the resultant impact on all asset classes, all markets, equity markets, bond markets may have a bit of a cap. But what is your thought? And will this be a prolonged impact or will it be a short-lived impact?
You know, this is a great day to be here, and I think we will see a sustained rally in both PSU banks as well as infra companies for two reasons. One is this is going to sustainably lower the credit costs for banks and PSU banks in particular. And second, all these huge indebted infra companies which have high levels of debt. Now, because of the bank recapitalization program on one side, and now the Moody's upgrade as in addition to that, will help banks to resolve the outstanding, some of the NPL issues, take haircuts and move on. So these companies, on the other hand, the infra companies, which are in essence the NPLs, or the troubled loans, they will now make a resolution, go out and raise capital. So I think it's hugely positive for both infra as well as banks.
You know, sorry, the question, Chakri, though, that this upgrade is coming in when we are trading at 10,350 odd for the markets. We are not at cheap valuations, and the earnings cycle, while might just be about turning, we don't know how smoothly and how quickly it will turn around in Q3 and Q4. Does that put a small bit of a lid on the enthusiasm for the near term? I mean, I'm saying, had we been at 8,500 on the markets and this upgrade would have come in, it would have been obvious that there is a sustained rally possible. At these levels, purely from an equity market perspective, on a levels mode, how much of a leg up does this give?
You know, basically, if you look at the previous quarter to the current quarter ongoing, you see there is a revenue acceleration that's happening at the Nifty level as well as at the BSE 500 level.
Yes.
And there's revenue is up roughly about 10-12%. EPS is up roughly about 13 to 15%, versus a decline in the previous quarter because of well-known issues. Yes. So as this trend continues over the next couple of quarters, clearly the multiple comes down. And these are depressed earnings anyway, and looking at PE on a depressed earnings is not the right thing to do, in my opinion, at this point in the economic cycle. And so when you have the ROE of these companies across board, India as a country has come down dramatically from 2007-8 to now. From about 18, 19, 20%, it has come to 13, 14%. So even a marginal uptick in ROEs will have a significant re-rating to multiples. So I do not think this is an expensive market.
But Chakri, you have spent so many years in markets. To what extent do the FIIs investing into equity really look at the ratings? Because we have a rating agency upgrading India, and look at what has happened over the last 6-8 months. FII money has not really been flowing the way it used to flow around a year back.
Yeah, we handle FII money as well, and I think this is a huge positive for FIIs, because as an FII, I also look at the potential impact on the rupee. And this credit upgrade will lead to a strengthening of the rupee versus the dollar, despite rising oil prices. And that translates into incremental higher returns for FIIs. So therefore, I think this is a very good sign for additional FII inflows.
Wow, okay. So, no, I think it's an important point, Pradeep, that you've raised out. Chakri, the only question is, would, for any FII right now, India is not the only fish in the pond. I mean, yesterday at the UBS conference, they have maintained that for a long time they have been structurally overweight India. It was their favorite market. Now they are moving positions to Brazil, to North Korea. Malaysia has emerged as a favorite because it being an oil exporting nation, and oil is at 60, 65, what we may. India is not the only fish in the pond. Indeed,
absolutely right. And Brazil has gone up because the commodities have shown a strengthening cycle. Malaysia for the same reason. And now India people invest for a different reason. India is still primarily a services-related market. 63% of the economy is services. So when you come to portfolio allocation from an MSCI perspective, you would look at the services uptick that will help. GST, etc., has resulted in a downtick, but that is transitory. They're doing a lot of repair work, the government, in cutting GST rates, etc. So India's percentage as MSCI basket is at a neutral position right now. So it's not overheated by any stretch statistically. So I think even a couple of percentage shift increase from 14 to 16 over the next 1 year or so will translate into a very big inflow.
Wow. Okay. since you watch the color of the money so closely, Chakri, would there be funds? I'm guessing the answer is a yes, but I'm just still asking you. Would there be funds that would be investing in countries based on certain benchmarks? One of the benchmarks would be MSCI. One of the benchmarks would be the external ratings of a country. And this having changed forces some money to come into India.
Indeed, absolutely yes, because one of the big trades today that's happening in the US for the US markets is people investing in high yield companies where they expect an upgrade of credit rating of those companies. Therefore, they are become safer credit profiles, which translate into higher stock market returns. So I think the same logic applies to India as a country in terms of the stock market. Because of well-known reasons, economic downturn, companies have not done well, low profit margins. Now, when you have the opposite cycle, translates into higher profits, sustainable profits, translates into higher stock prices.
Mm-hmm. Like you said, the infra companies would probably benefit, the financials would benefit. But if you really look at it, over the last few days, we have seen heavy sell-off in the heavily leveraged companies. Do you think there is really an opportunity here? Do you think there are companies that would actually benefit? Because the view that market has taken is that most of our companies in this sector, which are indebted, which have been in trouble, they probably don't have a chance to kind of turn around, and nobody's betting there.
The very highly the leveraged companies, all the names aside, the Jay Prakash's of the world, those will have a tougher time. But you have enough number of companies who have a fairly high level of leverage, but are manageable levels of leverage. And if that can be brought down, it will translate into sustainably stronger companies. I think so. If you take out the top 15, 20 accounts of highly stressed accounts, there are hundreds of companies out there. So at the aggregate, as these companies re-rate in this infra space, it leads to a sustainable improvement.
Let's get in our derivative expert and be tight-gutted right now, because that market would be moving with a frenzy. I think we've got a voice as well on the currency markets, but Chakri, just a quick word on the currency as well. This is that initial upgrade. You could pretty much map it on an Excel. The question mark is what next?
As long as the current upgrade, Moody's upgrade, is moved to stable. So as long as we see, and which I think we will, for various companies to refinance their loans and bring down their credit costs, that will translate into a rupee strengthening, that is from 64 moving 63, some number higher. So this path of fiscal consolidation, I think, is a great step for the rupee.
Yeah. But there will also be an important point. Even in last month, when FIIs were not that positive, actually RBI has bought more dollars and kind of tried and not to allow rupee to appreciate. So we are not really worried about depreciation in any case. Now, if more funds come in, that means RBI will have to probably buy more dollars, or it will have to allow rupee to appreciate. So that's going to be critical. And from the forex market viewpoint, actually 64.50 odd levels is something that they've kind of protected for a while. So we'll have to see whether RBI allows rupee to appreciate above that. So that is the kind of question every forex trader will have in mind. So we'll pause probably here with 1% uptick that we have seen early in the day, and then wait for a reaction coming from PSU banks and maybe RBI.
Okay. Well, that's Pradeep's view. Well, let's wait and watch for that. 64.67. We should get a phoner any moment, really, on the currency as well. Let's get in a trader or a currency expert really talk about it as well. But I'm guessing, I think what Chakri and Pradeep mentioned out here is pretty much something that will happen.
So when I checked for the last time, so Chakri, what you were actually mentioning that the corporate margins are depressed, and that is exactly in different words. CLSA has also mentioned that corporate profit as percentage of GDP have declined.
Indeed.
But do you think over next 12 to 18 months there is a possibility that margins would probably expand and we'll have more normalized level of EPS coming in, and therefore valuations would look much more reasonable?
Even if you look at from the previous quarter to the current ongoing quarter, you have seen that companies have taken various steps despite an environment of rising commodity and metal costs. So which means input costs for companies have gone up. And interest rates have been where they are. So there's been no change from last quarter to this quarter. In spite of this, there has been a margin improvement because of a marginal improvement in the top line. So as demand improves going forward, this trend will continue, and this therefore improves the profitability, or rather the profit margins. which is what is more important to the stock market rather than the absolute level of
I asked it
profits.
because we have been listening to this comment for several years now. For the last 3-4 years, we've been waiting for the margin expansion and the normalization to really happen.
So let's get in the pre-open rates as they have settled now, and you'll get a sense of how the markets have given that initial reaction to this piece of news. So let's just see that. So about 1% higher, 109. But I dare say, I don't know why I get a feeling that we may end the day higher than where we are right now. I may be completely wrong here, by the way. Not trying to predict what the markets would do, but just a sense that maybe, just maybe, there could be some more in store simply because there are so much short positions piled in the system that may play a part towards the latter half of trade. Keep in mind the global markets are positive. The global markets are not negative, and that only aids that small bit of sentiment that we'll have today. But let's wait and watch what happens there. As I said, almost all key stocks have started off on a positive note. State Bank of India more so. What would you do, Chakri? Would you go out and buy any of the larger banking names, not just purely as a result of this, but a set of tailwinds now that are coming in for the banking space at large and for the PSUs in particular?
You know, even if you asked me this question yesterday, I would say go ahead and buy SBI, Union Bank, PSU, L&T, all these companies. And today I'll still stick to the same line, which is because we think these stocks are growing at least 25-30% higher from current levels over the next 12 months. And if you look at a longer time horizon, I think these stocks go much, much higher.
Wow. Yeah, and viewers, mind you, I mean 20-30%, you may see mid caps moving around like that, but 20-30% in a year is a fairly decent set of returns, and for portfolio managers even more so. But even for a retail investor, 20-30% on a large cap name stable is a really good set of returns that people get in. So I mean, no surprise there, Chakri. I mean, this is what the reaction would be from almost any company which would either have the option of borrowing overseas or be linked to the country's rating agencies as well. No surprise at all. This would probably hold true for almost all corporate.
Indeed, and just like Mr. Surana mentioned, and that's exactly what we were alluding to earlier about an improvement of profit margins. Because even if a reduction of interest expense or refinancing of debt will translate into higher profits and higher profit margins, that translates into higher overall profitability. And therefore, if you look forward, now instead of FY 18-19, if you go FY 20, because if you are a beginning of a growth curve, then multiples start looking a bit more normalized.
Great. Gentlemen, Krishna Kumar Karwa, Chakri Lokapriya, thank you so much for taking the time out and being with us today on Bloomberg Quint. Really appreciate your time and your views.
Thank you.
Thank you. Thank you very much.